Good morning, everyone, and thank you very much for joining. Hope everyone had a good weekend. This is the first morning market review of the week. My name is Ross Oshaw, Senior Market Specialist at FXCM. My email address is r@fxcm.com, and of course, if anyone needs to contact me, that's the best way to do it. Today is Monday. It's the 9th of May, 2022. I'm just going to bring up our high-risk investment warning, and I'll keep this on screen for a few moments. Hey Zanetta, morning Raj, nice to have you guys on the webinar. Thank you everyone for joining. Hey Anna, happy Monday to you as well. Thank you so much for jumping into the webinar, much appreciated. Let's bring up the market commentaries disclaimer. And here is our references: MarketScope 2.0, cnbc.com, tradingview.com as well. In fact, I'll bring TradingView across. All right, we'll come back to that in a moment. Let's start off with the CNBC. Let's start off with the CNBC headlines, just so we understand what we need to know for today. There is Wednesday, just to let you guys know, Wednesday is CPI. We're going to get CPI on Wednesday, and there's at least three, I think four Fed officials that are speaking tomorrow. So we want to hear what they say. So just keep that in mind. Europe, the European markets note from CNBC. It has the headline: European stocks head for lower open as global markets remain rattled over inflation. European stocks are expected to open lower on Monday, continuing a negative trend that set in among global markets last week. The lower open anticipated for European markets comes after regional stocks retreated at the end of last trading week after a rout in US markets, with Wall Street posting its worst day since 2020 last Thursday. US stock futures fell on Sunday evening as traders looked for the market to find its footing after the dramatic week of trading. Last week, the Nasdaq composite lost 1.54%, while the S&P 500 and Dow dropped 0.21% and 0.24% respectively. It was the sixth straight losing week for the Dow and the fifth straight for the other two major indexes. Shares in Asia Pacific fell on Monday as investors watched for market reaction to Chinese trade data that came in better than expected. Investors are also keeping an eye on the war in Ukraine, as dozens are feared dead after a school in the Luhansk region in eastern Ukraine was hit by Russian shelling. Luhansk is one of the two regions that make up the Donbass, where Russian troops are now largely concentrating their attacks. Russia is also under scrutiny on Monday as it gears up for Victory Day, a holiday commemorating the Soviet Union's defeat of Nazi Germany in World War II. Strategists have said President Vladimir Putin could use the occasion, marked by massive military parades in Moscow, to announce a victory in Ukraine or to escalate the conflict. US First Lady Jill Biden made a surprise visit to Ukraine on Sunday. The US and group of 7 countries announced that they would increase short-term financial support for Ukraine as the war with Russia nears the 3-month mark. Earnings come from BioNTech on Monday, and there are no major data releases. All right, so those are the headlines. Okay, so what I have on screen here is the IEF. Just to let everyone know what IEF is. It's a bond ETF. Okay, but we're looking at bond prices here. We're not looking at bond yields. Yields are skyrocketing. They have an inverse relationship to bond prices, and you can see that the price of IEF has really just capitulated after. This is a monthly chart, so we've got 1, 2, 3, 4, 5, 7 months of decline. Yeah, it's a really steep decline, almost sort of a waterfall sort of in types of its structure. Just taking a look at the COPAC. Let's just bring in the COPAC here. I want to put in a horizontal line. All right, so what do we use the COPAC for? We're effectively looking for value. The COPAC in of itself is pretty good in terms of long-term cycle bottoms. It's not good in timing. Your entry is not, but the idea here is when it turns up from below zero, it's probably a good idea to keep an eye on that particular instrument. And what you can see here is, if you go back to 2006, turns up there, and there's a nice movement in bond prices. We go through to 2010, when it turns up, it's a nice movement in bond prices again. We go to 2014, nice movement. This is a false signal here. Okay, so this one, let's just give this a different color. Okay, so this blue one is a false signal. Let's just change this one back to red. Okay, and of course, this is a really good signal as well, 2018. And now, where we right now is we are capitulating. It's moving down. So there's no signal that's been given. Bonds are still in free fall, but at some stage they'll bottom. So what's the big deal when IEF bottom? It's probably at the same time that the 10-year yield's going to top, right? So that's why we look at it that way. So if we go US 10-year, the 10-year is absolutely rampaging. It's at 314. We take a look at it here. 314, absolutely rampaging. The COPAC's not going to help us here. The COPAC gave its signal over there, right, back in 2020. So that's, if you go back, this is probably when IEF topped, because the yields start moving up. So what am I suggesting here? Just suggesting that it's a good idea to keep an eye on the bottom of IEF, because it's probably would be the top of the US 10-year. If you think about it sort of in terms of just investment, if you had to buy a bond, a 10-year bond now, and hold it to maturity, you're getting in at a really low price, and you're getting a pretty good yield on it. And that might be drawing funds away from the risk markets, because the yield's starting to look pretty good. And the way that we can say that the yield's starting to look pretty good, well, let's take the nominal. So let me just be very clear what we're looking at here in terms of the US 10 yield. I just want to, we're looking at something called a nominal yield. And the nominal yield is telling us let me try that again. So you can see we've got 3.14, let's call it 3.15%, right? So we've got 3.15%. It's made up of two components. It's made up of a real component, and it's made up of an inflation component. And that's what we call a nominal yield. And we probably got a lot of inflation movement at the beginning, but happening now is real yields are starting to move. How do we see that real yields are starting to move? So you just pick off the break even from here, the 10-year break even, which would be this guy here. So just go US 10-year, the nominal minus the break even. All right, and you can see that there is now a ton of real yield that's starting to show itself as per these financial instruments. So real rates are now positive. When it was below zero, okay, real rates were negative, and now they positive. So real rates turning positive means that they're beating inflation. Well, that's quite attractive. Now, when you really think about it, you've got to ask yourselves, well, are they really beating inflation? And the answer to that is probably not. Real inflation, so when we look at the headline inflation number, it's much higher. As this continues to move up, imagine that this gets to a part where it's taking out sort of the headline number. I think that would be a real incentive to look for fixed income. These are 10 years. We're looking at the 10-year. So the idea here is, and we're looking at the 10-year because that's really what determines is determined by investors. So we want to just keep an eye on that. When we look at, say, a 2-year, 2 years different. 2 years different. 2 years, the front end, that's very much aligned with monetary policy. Very much aligned with monetary policy. How do we know it's aligned with monetary policy? Just throw the Fed funds rate on top of this, and you'll see. You just go add the Fed funds rate. So we looked at this last week, and it's pretty closely correlated. And here's the gap. So the Fed is the IEF. The IEF is 7 to 10 years. It's 7 to 10 years. So if you take a look at IEF, it actually in the description will tell you 7 to 10. Okay, so we're looking sort of more on the longer term side over here. But the point there, I think, Anna, is that there is value that is starting to show itself in the bond market. Let's just take this out, and let's put back the COPOC indicator. All right, so here's the COPOC. I'll just change this up again. And we want to now see where there's other pockets of value, because markets are getting really damn basted. We looked, I think, 2 weeks ago at the China 50. This is one that you can bring up. And let's just put in a 0 here. All right, so you see the China 50 now is starting to show some value as well. It's still dropping. It hasn't given a signal, right? Just because it's under 50, that's not the signal. The signal is when it turns up under 50. Okay, and the China 50 over here, just between 2010 and 2016, seems a little odd. So the COPOC here is not the best signals I've ever seen, but finally, sort of when it kicks up here, it moves nicely. But right now, the sell-off is presenting probably some good companies at a relatively decent price. We can start looking at this at other risk markets. Let's take a look at SPX, right? So here's the S&P 500. Do we have any value here yet? And the answer to that is no, we actually don't. Okay, that's not a great sign. Let's bring this in 0. Okay, so the last Copac, the last Copac signal was here back in 2016. It was a terrific signal. It was very shallow, and that really launched the index here. But we're very far from getting any sort of Copac signal here. So what does that suggest? Well, I'm not sure if the setting's completely over with. So we've got yields that have moved, real yields that have moved positive. I think that's a big deal. We've got to a point where the IEF bond prices are showing value. I don't know if they've bottomed. I'm not going to call it a bottom, okay, because the Copac hasn't suggested as such, but certainly it's in value territory. If you go and buy a bond now, you're probably getting it at a fairly good price, considering the yield to maturity, right? If you hold it to maturity, well, that may suggest money rotating out of risk markets, out of SPX, just to find that, you know, just that getting that yield at a really good sort of price. Yields probably still moving up. So prices of bonds probably going to move down. But if you get in now, maybe fund managers will be thinking of averaging their price in, right? So that's just one of the sort of psychological mechanisms that may be contributing to the reallocation of capital. Let's go through to NASDAQ. See what's happening on NASDAQ. Okay, let's put in the 0. So you can see here, the last real Copac was back down here in 2009. This was not quite a Copac signal here. So, you know, I think we've got to look at this in terms of where's SPX turning from, where's NASDAQ turning from. Nevertheless, it's still got quite a way to go before it even reaches the 0 boundary. So again, given the fact that real yields are moving, and this is a growth index, I'm not sure that we're completely done here, right? Not sure we're completely done here. Let's take a look at the Dow Jones. So the Dow Jones, your more mature companies, right? It's a stock of 30. Let's take a look here and see what's happening. So the US market's showing a distinct lack of value at the moment on a long-term basis. Now, you can see there's a signal back here. Let's just put in the signals back here. Got a signal back here. Okay. Got a terrific signal back here. We still got a long way to go here before we can say, well, there's true value in the market. Now, again, let's just make a sort of a clarification here. Just because we don't have the Copac below 0 doesn't mean the stock market can't go up. For maybe money would go in. What the Copac tends to tell you is if there is value. Right now, an argument can be made, well, there's no value in the risk markets, particularly the US risk markets, because there's value in a competing asset class. What asset class? Bonds. Okay, let's take a look at a few others here. Let's take a look at DAX. All right, again, let's put in the 0 just so it's easy to see. All right, so that's getting pretty close to the zero line. It seems to be a little bit closer than the US indices. Let's just take a look here with the signals. All right. These are the signals. So we're still not quite at that value area. Take a look at US dollar. Okay, let's put in the 0. All right, and you can see that with the FXCMs, I mean, this one's not quite a signal, but I'll put it in anyway in hindsight. Here's a nice dollar signal. Here's a nice dollar signal. So dollar is not value anymore. Right? It was clearly value when it was quantitative easing. Now we're moving into quantitative tightening. We've lost the value aspect. It's now moving into a growth type of phase. The question is, well, how much higher can it go? The COPOC doesn't answer that question. Okay, COPOC above 0 becomes meaningless. That's not the way it was designed by Edwin COPOC. It's about turning up from below 0. Let's take a look at XAU. Okay, so now we're looking at gold. So we know that the dollar is appreciating, right? So what's happening to the gold, 1 troy ounce of gold per US dollar? Let's take a look. All right, let's put in our horizontal. This is an interesting chart, isn't it? All right. So gold seems a little bit more fallible. Sorry, looks more a little bit. It looks a little more prone to error. Let's put that. Yeah, it's going down. So perhaps COPOC's not the greatest indicator in terms of the gold cycle. Nevertheless, what I do find interesting about it, it did flash a buy signal here. That's a bit strange. I've got to try and think about that. So I think the conclusion there is that a troy ounce of gold probably did have some sort of value, probably did get pushed down to a point that the COPOC recognizes that it's maybe something that is worth considering. The problem, and being a safe haven, it makes sense because we are in a world which is fraught with uncertainty. The potential impact of the higher dollar here is perhaps just confusing the issue a little bit here. That's maybe why we have this, because it's not a standalone. Let me think if what I'm saying makes any sense at all. No, I don't think so. I think that the gold cycle just may not be the best type of instrument in terms of COPOC, but we'll keep an eye on it. It has turned up. No question, US dollar will be adding a pressure to this. We can add a Bitcoin to this as well. All right, so Bitcoin is, let's put it at 0. I would suggest it probably doesn't is probably one of those instruments that maybe the COPOC doesn't suit particularly well, but we're not quite under zero yet. All right, so Anna's got the FTSE. Yeah, let's take a look at FTSE. So the UK 100 is actually doing really well at the moment, and that's because it's got a large commodities component to it. It's outperforming. So let's just bring that in. So you can see that the FTSE is a completely different cycle here. It hasn't sold down nearly as viciously as the US. I mean, you've got Royal Dutch Shell, you've got strong commodity presence in the FTSE 100, and I suggest that's reflected here. A couple of questions. Rob's just asking, the COPOC is based on a 10-month moving average of a rate of change. Do you think we are 6 months too early for a signal? We have been declining since around about January. The COPOC indicator is never going to be accurate in terms of timing, Rob. It's not when I say it's never going to be accurate in terms of timing, I've got to just be very careful with that. Let me add the word with precise timing. Okay, it's not going to give you a signal at the exact bottom. It can't. There is going to be a lag, because as you say, it's based on a long-term moving average. The rate of change is also like the long-term rate of change. I think the rate of change, subject to corrections, around about a 14-month, 11-month range. I think there's some sort of calculation there as well. It's never going to give you an exact signal. The way that the COPOC effectively is used, I think there's a few ways that we can work it. It's the sum of 11 and 14. Yeah, so that's it. So the idea here is the COPOC is a long-only indicator. It's not going to give you sort of sell signals. It wasn't designed to give you any sell signals. You've got to find some other methodology to do that. It was designed specifically for using on a US stock market index to give a roundabout signal, sort of an approximate signal of when there's value in the market. And it was effectively implemented in stages. So let's just say you had 100% of capital available for investing. You can perhaps, again, don't take this as advice, take this as sort of educational, perhaps allocate a small percentage when the COPOC flashes a buy signal, and kind of build up a position over time as the market confirms, because the COPOC is prone to giving false signals. So it's a very much a bird's eye view. So don't take it as exact, because that's going to certainly be an incorrect interpretation. And I've also seen other analysts use it in odd ways. So for example, some analysts use it with a price above zero, and that's not the way it was designed. So I kind of defend the original work by Edwin COPOC, and you know, I've had arguments with analysts previously saying they use it incorrectly. They also use it on different time frames, and I think, well, I think that's silly. It's specifically made for a long-term bird's eye view. It's not made for short-term signals. I think there's better indicators for it on the short term. But anyways, at the end of the day, as long as you sort of positive in your account balance, I think you'll be okay. But the answer to your question there is, don't use this as an exact timing tool. It's a monthly tool. It's going to lag, and it can, as you can say, it can lag by 6 months. It might be premature as well. No, I don't think it'll be premature. It will tend to lag. So if we go back to the China 50, the China 50 might start turning up. COPOC will only give that signal later. But in the grand scheme of things, it gives a really good signal near the bottom. Okay. Can you use it for thematic ETFs? does it work? So again, it wasn't designed for thematic ETFs. It was really designed for stock market. But I think that the ETFs weren't around when it was developed. And I would suggest that you probably could, Anna, but the same caveats would apply there. It's not an exact, nothing's exact in this game, but it gives relatively good, it gives you a relatively good idea when there's value in the market. The problem with value is that value can become deep value because it carries on going down. So that's why it's worth probably waiting for that signal to turn up. So let's just reiterate what we've spoken about this morning, because it's a very much a broad sort of bird's eye view, is that the bond market seems to be showing good value at the moment. Again, it's probably going to show deep value. In other words, the price has probably continued down. It's probably looking attractive though, given the yields, the way yields are moving. It's also probably a time when portfolio managers will start moving money, understanding that bond prices may not have bought, but they'll just average it. They'll average it in a very professional manner, and they'll get quite a smooth entry. And that may be pulling money away from the risk markets. And if it's pulling money away from the risk markets, well, then we are, you know, in trouble in terms of the bottom of the risk markets. The idea here as well, when we couple this with the analysis we did last week. Remember the analysis we did last week when we looked at the lag in employment? I'll do that analysis again sometime this week. And that lag in unemployment, given where we are with inflation, given where we are with the Fed's fund rate, given where we are with the slowdown in GDP growth, that also suggests we may be in trouble in terms of the stock market. So I'm not particularly confident of finding a stock market bottom. We may have some bounces, but I need more evidence to be happy that we found some sort of stock market, bottom. And it's just saying, what about E1 as well? We can bring up, of course, the Bund, which is now looking very good relative to where it was. It's over 1%. I mean, it spent many years below. Spent many years below the it spent many years below the zero line, and now it's up. It's actually 1.14. And I think when the German Bund is moving, well, that's probably a good indication that global yields are on the move, right? I think that just another bank that is really fighting a battle that I'm not sure they're going to win is the Japanese. They're defending 25 basis points. But we're going to get global yields. You just saw the German Bund is moving up. There's now talk of ECB starting to raise rates. I reckon we get one either in June or July. My guess is July. But we're just going to have to look at the I guess the communication. One last thing just to mention is, of course, I think the Bank of England's statement really was an important statement globally. They basically are extremely worried of stagflation. They're looking at high inflation going into the double digits towards the end of the year, and they're forecasting a slowdown in growth. That is stagflation. So the fact that the Bank of England came out with that statement, I think says a lot. I think the Fed probably heads in that direction. Europe probably heads in that direction. Very, very scary environment to be in. Bonds, all of a sudden, you're getting positive real rates. The bond market probably hasn't bottomed yet. Gee, I'm not sure stocks have bottomed at the moment either. So we'll keep an eye on that. Dollar is not value. There's no value in the dollar. It's in the growth stage now. Okay, so we just now have to see when that growth stage starts waning. When that growth stage starts waning, we can use the COPOP to see if the other instruments are starting to show signs of bottom. It's very, very interesting intermarket forces at work at the moment. Have I answered everyone's questions? I think I got all the questions there. So EU bonds, and I think is a great question. I think they are effectively I mean, I think you can make a good point saying, well, if the bunds are moving up, then global yields are moving up. Is there a way of knowing whether the dollar is keeping up with inflation? I guess there is. Let me just think. Can you clarify the question at all? A stronger dollar would tend to combat inflation. Is that what you're asking? Is it able to combat inflation? And I would suggest it's probably earning dollars but spending euros. So that's actually a complex question, because I guess it depends what the inflation rate in your particular region is, compared with the appreciation in the US dollar. I would say this. I would say that it's probably, and I would say it's probably the best instrument to have been in since we've seen the inflation move over the last sort of 12 months. No doubt about it. So if you go through to the euro, well, clearly your purchasing power is weakening in the euro. Okay, so your purchasing is losing in euro. So the US dollar certainly would be it's very good to be earning dollars and then spending in euro in this environment. If that's so, does that answer your question? Whether it's keeping up or not, I've got to do the calculation. I would suggest it's fairly close. Yeah, I'd suggest it's fairly close. All right. Any other questions there? Okay, cool. So I think let's wrap up here. You guys have my email address, and then we will look at it again tomorrow. We'll go into more granularity tomorrow. Thanks very much, guys.